Okay, so let's get started then. Good morning, good afternoon, and evening, everyone. And thanks a lot for taking the time to join this webinar. I'm Giuseppe Basile. I'm also known as the Fitch Talker, and I will be your host today. I want to thank fstraight.com and particularly Arinda and Vicky for making this webinar possible. And you know, FStreet staff is always there to help. So I'm going to talk about the fallacy of technical analysis today, and we should also have some time for live markets review. If you have some pairs, you will let me know, and we'll look at them together. So this in this webinar, I'm going to talk very briefly about my introduction, very briefly. I will then talk about the fallacy of the traditional technical analysis and what I've learned in the years and what I see at the moment. We will do an analysis, and then I'll talk about some resources and references. Now, you know, risk is very important. Please take the time to read this slide. Remember that trading is a game you win in defense, and you know, I use the acronym PPC, Protect Precious Capital, which is not only financial capital, that's very important. Of course, it's also emotional capital. When the money is gone, the game is over. So, you know that trading Forex carries a high level of risk, and it might not be suitable for all investors. Particularly, do not trade if you have to pay your bills with your gains. So that's very important. So if you're watching the recording of this webinar, just stop and read this slide now. Very briefly about me, I'm a computer science engineer and took up Master's in Finance in 2010, CMT in 2011, 2012. I started in 2001, started with my own research then 2003, and I really was important for me to study with mentors starting from 2006. I had some mentors, very important, David Hesley, Judy Napoli. I have a lot of thousands of hours of exposure, and especially in the last few years. I've started that blog in 2012 to talk about the different way of looking at the market. And I'm also an associate of IFTA, which is the International Federation of Technical Analysts. I started FIBS Talker Trade in 2014, and I will have my first group coaching program in October. So the trading edge I have, it's based on the work of David Hesley, spotting algos trading footprints on price, mainly, but I've introduced a lot of elements from Vantarcho di Napoli and my own research as well. Particularly, I don't look at the market very closely because I'm a swing trader. So for me, it's important to adapt the methods to my own style, and I'm actually a swing trader. So am I qualified to speak about the fallacies of technical analysis? Well, I have some experience, 13 years already, so I'll go very quickly on this. I averaged more than 20 hours per week on top of the work I already did. And I'm a researcher, as I said, for IFTA, and I published 3 research papers in the last 3 years. These papers go through a rigorous scrutiny, and I made several formal research efforts, investigating the effects of algorithms and high-frequency trading on price, analyzing trading and designing trading methods. I've also made a study on money management techniques and their relations with trading objectives, and some other work, including new price patterns based on the presence of algorithms. Let me dive into it. So let me share what I've learned about what I believe and know about technical analysis. So a little bit of a warning here for you before we start. In this webinar, I will challenge some of your deeper beliefs about the markets and how the market works. So be prepared for that. If you hate me at the end, it means that, I've hit the target, and it doesn't matter. I mean, of course, I don't want you to hate me, Just kidding here. I will also be a little bit sarcastic, but not disrespectful. But after all, I'm talking about a failure here, and I will need to be a little bit harsh if you wish. Now, I hope you don't hear there's some noise coming from outside, but unfortunately, there's nothing I can do about it. So, but there are other options, of course. If the content just leaves you indifferent, I'm even more worried because now, what I will do, I'll ask you to, take the blue pill and wish you good luck. Then you can go on and continue. I believe nobody or very few people tell you the things that I'm going to tell you here. 95% of traders lose money in the market, and they don't make any money in the market. Statistics are against you, and let me say that, let me be blunt, you are statistically a loser. Yes, I understand this is a bit harsh, but there can be another outcome also. If you love what I say and what I'm going to show to you, then keep listening to what I have to say. Maybe you love me, you never know. So the reality of technical analysis. Let me have this question for you, okay? And try to answer very honestly here. Tell me, what do you think technical analysis really is? And I'm gonna pause here a little bit. Please write down what you believe it is very, very quickly. What comes to your mind? It's not important what you write, but please do. What do you think technical analysis is? Go on, please. Offer me something. Write down something for me. Are you there? Give me a yes if you are there. Let me see something. Okay. Let me see that you're not still sleeping as I am actually. No, just kidding here. But keep thinking about it. Hello, Pantelis. Keep thinking about it. And let me give you this. So, in order to understand, this is not a simple question, okay? Yes, go on. Previous price action repeats the analysis of human behavior vis-a-vis price. Nice. Any other ideas? I'm here listening to you. If you have any other ideas, write them down. So, yes, these are some of the ideas, but I always take a radical, starting point, and so this question is not easy. Okay, I understand that, but in order to really define it, let's see first of all where it came from. So where does it come from? It's really a way of reading probabilities into indicators. And in the years, a lot of engineers made their discovery public. And so who are these people? I mean, some of these people may be Leonardo Pisano, Fibonacci principles. I mean, I use Fibonacci a lot. There are a lot of people who like the Fibonacci concept. Charles Darwin, the granddaddy, the daddy, the person who actually identified the down theory, and the first person actually who formalized the concept of trends in the market. And after that also the down index came in. Gann was the person who introduced the cyclic studies and squaring time and price. What does that mean? That means that now there is a regularity in price, and there are also highs and lows that correspond to a specific period, regular period in time. Elliott with the Elliott-Wick studies, Wilders with the mathematics of overbought and oversold here, by introducing the DI plus, DI minus, the ADX, the relative strength index, and then there were others who came, stochastic, MACD, and more recently John Bollinger, if you wish, the bands, with the Bollinger bands. And by the way, I met Bollinger last year in Italy in May when I was at the largest event on investment trading last year in Rimini in Italy. And more recently, maybe Alexander Elder with his multi-frame analysis confirmation. So what we have here is that the fact that when we implement all this, when we implement all this, let me see if you're writing anything here. So again, statistic of the past market activity, trying to project to the future market price. I love this. Thanks, Pantelis. And that's, I think you are very, very close. That's exactly it. So if we implement all these studies into charts, we will see this. We'll just see a beautiful piece of modern art. And let me offer you an example here. It could be something. Like this. And to be honest with you, I wouldn't be able to trade something like this. I respect deeply people who are able to interpret so much information. I'm not the person who can do that. Still, there are a lot of people who can actually, or they think they can do that. So, what are the effects of of using all these indicators together to have nothing more than something that dazzle the beginner trader, and confuse beginners, but I can tell you they confuse experienced traders as well, and even more sometimes. And there are charting specialists, then they come into the picture, and you can see some of these things here. Excuse me. But there are also other things that are not evident here, like linear charts, high-low bar charts, Japanese candlestick, point and figure, and the more you have, the more you can add actually. So clearly here, on top of that, we have to add that there is a lot of originality being added nowadays, and there are mutated techniques available. But what's the value really of this technique? Very often they actually keep lagging the market, and they only give a different, nice way of representing the same information. So the important truth about these techniques and indicators is that actually they basically, as Pantelis and indicated, are statistical tables plotted in graphic form, and they represent just a picture to help in the decision process. So that's the reality of it, and the decision process is very, very important. As traders, we are paid to take good decision. We are decision makers who are paid for the quality of the decision we take. Now, can we hope to get the decision process right if we don't even know and understand the nature of the data and information we look at? So that has to be. This is a very important point, and has to be very, very clear. So do then technical analysis studies really work, or we have a problem here? Because a lot of people spend a lot of time in identifying and internalizing rules that they use to add the additional information on top of what the indicators are giving us. Because clearly the indicators are not predictive. And actually the indicators were not invented to be predictive, and I'll talk to you about this later on. Now, I'm talking a lot on this presentation, but I guarantee that there will be some wow moments for you. So bear with me if on this. And we will look at also at charts and an alternative later on. So the studies can work in some markets, conditions all the time, but only sometimes in all market conditions, and not all the market conditions all of the time. So this has to be very, very clear. So how do we reconcile this? And think carefully about what you read here, and what does that mean for you. So we have a problem here, and the problem is that some people, or the majority of people, I would say, and that includes technical analysis analyst, and I am a CCMT myself, use TA studies if they were the holy grail and they were the trading path to millions, and that's that's not the way. And how far from the truth it is. Ask how many people have do think this. And by the way, what do you think about this? Write down what you think about this, and we will reason about that later on. So clearly, any good, brain person should realize that these are just tools, and they're built on historical and lagging databases. So sorry for the noise here. Unfortunately, there's nothing I can do about that. So. Moreover, I mean, we have to think that there are indicators that require parameters, and the rigidity of the parameters on the studies imposes also, of course, rigid response to changing market conditions, right? So, the market. So the market. What is the market? What is the nature of the market? The market is a live beast. At least that's what they say. And it can throw at us everything. So it changes all the time, and it's the results, they say, of a beast that adapts to traded behaviors. I have slightly different ideas, and those who follow me know that I look at trading patterns and trading behavior. So, and the market is the sum of all the behavior of the participant engaged. Now we have to reflect here: who are these participants? Are only there human agents or are computer-based agents? Because and how many? What's the volume that is traded by the computer-based agents? Because this is going to change totally the picture. Do you understand that? So all these studies, of course, have tools like a thermometer, a meter for doctors or carpenters. So when we know this, right, that when we know that the participation in the market may be different, very much different from the participation that we had when these tools were created, then how can we consider this holy grail? So this is what I call the psychological elements that hide the fallacy of technical analysis. And so it is a lie hidden in plain sight, and why and how that happens. And this might well be due, and often it's due to ignorance, especially from the new people and the uninitiated ones. It may come from laziness. Think, for example, of automation and all the hype that there is on automation and expert advisors. Or can be plain stubbornness. People who believe they got it and they keep going with their way, while more knowledge is never a dangerous thing here. So could this be due to manipulation? Well, I'll talk about this a little bit later. But there is a truth, though, that, and I have no other way of telling this to you. If you use technical studies as your holy grail, then I have only one word for you. You're a gambler. Now, now you're gonna hate me, and I know that. And actually, I told you that statistically you're a loser, and also told you now that you're a gambler. So how much do you hate me now? But before you hate me, and actually. Let me give you an additional reason to do so. Let me demonstrate that actually you are a gambler. So I'm happy you got your attention, and actually Pantel is saying that he has been there as well. So we have all been there at some point. We were gamblers at some point. Okay, so. Let me demonstrate that you're a gambler, and I got your attention. I hope you don't hate me that much, Padman. So, but anyway, gambling. How do we define gambling? It's gambling. It's when we play a game with a negative expectancy. Before I proceed, how many people know what expectancy is in trading? Give me a yes if you know it. Give me a no if you don't know what expectancy is. Okay, yes from Ron. Pantelis, no. Padman, yes. Any other people? Do you know what expectancy is? Don't go on Google. Not now. Not just yet. Okay. So George, yes. Okay. Don't go on Google now. Made, yes. Good. So that's I'm glad you do. For those who don't know, expectancy is the dollar gain for each dollar risk in average. So let's say that um, I gain $0.5 dollars for each dollar I risk. If I can do that, that's quite a good expectancy because now if I can have, let's say, 10 trade every month, I can do, and I risk 1%, I can do 5%, and so on. So if I can do more, uh, uh, so 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 when we have a high expectancy, we need a lower number of trades to make money. So a casino must run games that are negative expectancy for patrons, for customers. Why is that the case? Because otherwise there couldn't be no jackpots because the casino has to win more often than it pays you. And in Lotto is the same. You statistically you're a loser again. Sorry, Lotto players will lose more in average than what the Lotto company collects. And in fact, what happens is that when you buy a lotto ticket, you lost your money already, in average, right? Because that money goes to create a jackpot. So, but hey, I mean, trading can be can be a positive expectancy game. And in fact, there are some differences when you compare these to casinos or lotto and so on, because there are rules, because there is the possibility to exit and reverse. For example, if you buy a lotto ticket, you cannot go back to the shop and say, you know what, I changed my mind before the lotto is, before the lotto time. But you can do this in trading because you can exit a position and reverse the position, for example. And also you have other tools like money and risk management you can use to create, a better future for you. So this is what gambling is. So now, do you know what is your expectancy, the method of your expectancy? Sorry, the expectancy of your method. Now, you might know the concept, but do you know the number, the actual number? Give me a yes if you know it. Give me a no if you don't. And if you don't say anything, I will assume that you don't. So go ahead, do it now. Very good. Ron now knows that. Padman knows that. Very good. George knows that very well. So you know the actual number, right? That's what I'm assuming, which is good. And we have over 30 attendees, so only 3 people are telling me that. So that's a good that's a good 10%. But what is the other 90%? And see where these numbers they come again and again, 90%, 95%. So for all those who answered no, and you likely did, you are actually a gambler, and you are not a professional gambler. So sorry, don't hate me. I'm not being blunt. I'm just trying to uh, give you some information, trying to joke and being a little bit sarcastic as well. So why you're not? Because if you use traditional studies as they are, and have a reliability of around 50% or random, that's what the studies give you. So when you consider lagging, mistakes that we all do, cost of doing trading, the slippage, and additional complex rules to fit the data, then your expectancy, even if you know it, is for sure negative, because if 50% random, so if you don't have big reward to risk, you're not gonna make more than what you lose, and plus you have all these other mistake you can do. So see, I proved you're a gambler. Sorry for that. So okay, so joke aside, yeah. So how do we bake the cake then? How do we put all this information together, knowing that now the technical analysis tools, do not actually alone help us being successful in trading. So success is a mix of ingredients, and I will list only 3 of them. I have 7 of them. I call them the 7 pillars of trading in modern markets, successful trading in modern markets. So market price, structure, market structure, and this is price structure, and I use indication for algorithms and other patterns I've identified in order to identify structure. Meaning the trader and your psychology, and the capitalization that can be financial and emotional. Of course, this can money management. There are more of this, but these are probably the more important. So why we use technical analysis then, and what are the problems? So it gives us something we need badly, and what we need a reason to buy and sell. We are all humans, so we need the reason to do things. And people do not realize, though, that there were some rules that were given to them, and now they believe those rules are the holy grail, are the reality. And any action that we would need would require a reason to do it. So this is what the technical analysis does for a trader. It gives a reason to buy and sell. And we also need to believe that everything happens for a reason. In real life, that applies, but in trading, things are quite different. So there may be a lot of reasons why price drops or rise. And I believe, again, the work of Mark Douglas, Trading in the Zone, actually identifies this aspect of trading very, very well. So the indicators may provide traders with some help in making the trading decisions, and provided that those indicators are responsible, providing that you believe that those indicators are responsible for the outcome of the trade. But the point is that they're not. They cannot influence the outcome of a trade. They are just a statistical indication. So what's the problem then? Is that people, they try to make those indicators provide perfect signals, and also tweak them, and actually adding rules. And I see that a lot also in supply and demand. There are tens of rules, and all these rules only help to fit data, only help integrate indicator to fit that past data in order to have something that describes better what happens. But the point is that we do this with an idea of believing that we can get the perfect signals, and actually we cannot get the perfect signal. And we just have to. The best way to go is to use the indicators for what they can actually give, the little edge that they can give, and that will not be able to provide perfect signals. So I see a lot of people who, and I hear from them, I speak to them, and they want to actually, they want actually to keep tweaking and adding rules to provide, an additional way of predicting price. But the problem is that indicators, they have another problem. They have no power, no predictive power. And actually, indicators, are just derived from historical database. So how they can possibly predict the future? Statistically, yes, 50% of the time, and that's what we can get. So there are always intense, arguments among, especially newbies and people who just started, whether, for example, how important are previous highs and lows. And this is also a tenet of some of the techniques like supply and demand and other techniques. And are these key levels relevant because they presented in the past? Well, if you speak with FX market makers, they will capitalize on those levels. They call them. They even have a name for that. sitting duck levels, and they sweep them all the time, and they explore the stop zone, and this happens all the time, all the time. So how can we believe that those levels are key levels, right? I mean, the fact that the price might actually bounce from this level is one thing, but the actual reliability with which that happens is something totally different. So other problems and issues are that charts are too overcrowded with indicators, and I believe, and this is a very important point, mind this point, this is a very important point. I think that a lot of traders, they are neglecting the feel the trend aspect of the indicators. See, indicators were devised not to be used for timing. They were devised to be used for trend following. And apparently, even technical analysts forget that. So we want to use indicators now. We want to tweak them to use them for timing as well. Who are we to do that? Who am I? Who are we to do that? So, it's a very dangerous mindset to depend on the predictive indicators reads. There is not such a thing. I'm sorry to say that. So I want to this point brings back. First of all, let me stop here because I'm giving you a lot of information here, and I just want to ask you whether you have any questions at this point that you want me to address or answer. I mean, I actually covered quite a lot here. I also would like just let me check the time. In the meantime, if you have any questions, please write those questions down, please. I don't see any questions for now, but if you have any questions, you can come to me. And actually, time is passing by very, very quickly, so I want to cover very quickly then. Self-fulfilling prophecy. Consider what I have told you so far. Is this real? Well, to me, this is a flawed concept, and it is true that price reaction can be observed and there are bounces, but it's also true that there is no associated activity of professionals or computer-based agents when it comes to this area. So are the self-fulfilling prophecies really the way where we should be trading, and where something is happening, something that can provide us with a good reward to risk ratio? No, I don't think so. And on the contrary, what happens is that these spots are taken advantage of regularly. Paul is saying, looks like you have plenty of time. Unfortunately, I only have 15 minutes left. So what is the net effect then? That making money out of self-fulfilling prophecies becomes quite a difficult job, but still a lot of people, still believe that the market is, their edge is into self-fulfilling prophecy. The market are totally changed, and further promotion of technical analysis fallacies come from the black box approach, the so-called expert advisors. There is a lot of hype on it. And, but in my experience, each and every of them that I've studied in the past fails over the long run. So, and the reason is, can past data, and you know the answer to this question already, right? Can past data predict the future consistently? So, of course, it can. And there are also more issues coming in. There is a trend where it's more true science and math is creeping into the market, like, it was able to explain better the market. And something as simple as Fibonacci used in the traditional way is not able to do that. And if you want to have a look at what I've in my past webinar, I speak a lot about Fibonacci, now I filter and drop a lot of those numbers and a lot of engineering that happened around those numbers. Leonardo Pisano came with something very, very simple, a ratio between two numbers, and now we have 38.2%, 78.6%, and so on. all these are engineered creations from humans. And and the most important aspect, I've told you before, TA models, TA studies were never depicted to be predictive. They were depicted to go with the trend, to have a way that would indicate that the trend was active and was on. So is there a hope? I mean, you would really hate me. It would be very bad if I didn't give you an opportunity here. So in which market are we in? Are modern markets the same as the past market? No, this is my belief. And again, some of this belief might sound very bold to you, or maybe difficult to process. These are my beliefs. I believe that algorithms govern modern markets. Yes, that's what I believe. And I have the proof for that. I'm going to provide the proof to you as well. And I believe that, we can actually, I believe that computer-based algorithms do indeed govern the market. And I don't think that we no longer live in a beast in which we face each other. I think we face a few monsters, and this can be proved. It's not a conspiracy theory. I don't think that all the biggest bank and institution use a shared platform, or they came together so they don't go against each other. This might still be, but. This might still be possible, but the monster I talk about are called algorithmic trading and subclasses of it, like program trading and high-frequency trading, and their participation in the markets is so massive that they leave track on price on the large and on the small time frame, and they can actually affect price structure and create trends in all time frames. And the point is that they can only be active on high volume markets, for example Forex, but they're also active on stocks, high volume stocks, some commodities, index futures. And yes, I think they have their own agenda, and they can push price higher or lower for months, and I can show you that they can do this for years, but ultimately they have to respect the fundamentals. So actually, they're not able, in my belief, to corner the market, and they definitely have to follow this rule. So do you know now that for everything I say, I like to give a proof, and so let me give you the proof of their existence. Here is the proof. Over 80% of market volume is traded by algorithms. And I'll show you that this is an opportunity. Over 80% in the futures market, we know it, the CME. And we saw things like the flash crash. I was there that day in May 2010. 20% of volume was estimated in options in 2010. Today it's much higher. Forex was estimated 25% in 2006, 45% in 2010, and it is believed it's well above 50% today. High-frequency trading is estimated between 35 and 75% of equity markets in Europe and in North America, and other markets are adapting. I don't know if you know it, but there is a tunnel below New York, between New York and Chicago. It's not a tunnel. It's actually a cable that gives some of these algorithms 30 milliseconds of advantage, and those 30 milliseconds mean a lot of money. And there are some class of algorithms estimated to move 20 to 30% of the market. And this is not my fantasy. This is proven, and you can look at the sources here. So, are you sure you want to keep using traditional methods when you know that now the markets are totally different? And again, as I told you, this is not a fantasy. TA is not the best solution, and for a lot of people, I'm going very quick here. Yes, the webinar is being recorded, MRC. for many, learning and internalize trading is learning and internalize tens of rules. You're very welcome, Mercy. But they do this only to fit past data. They do this to trying to obtain higher reliability and probability trading plans. But the returns will always be suboptimal. And the rules, of course, then they have to be complex, right? Because trading is difficult, right? But wait a moment, take another viewpoint. How is that the many new and experienced traders consider that traditional tools are the best tool that is there? Why do they never consider that they might not be the best tool in modeling the markets? And actually, I know I'm challenging a lot of beliefs here, and I'm going against the mainstream. This is not the common presentation you'll find in the mainstream. And because the mainstream, they would start and say, okay, let's look at the markets. Let's put this Gartner. Let's use these indicators, or let's use these trend lines. And that's not my approach. My approach is is there a different way of modeling the market? Because technical analysis as we use it today, it's a poor at modeling the market. So can you see it now? We have to do a lot of effort in making rules complex in order to make something that poorly describes the market to make it work. So can we employ simple rules on the other side? Is that possible? Well, I believe effectiveness of a method does not come from the complexity of the rules, but how good the model is, and that's the main problem. And I showed you now that technical analysis, it's not a good model. It's not the number of rules and their complexity; it's whether the rules are grounded into the way the market works. And when I say grounded, let me give you two examples of something that is really grounded, because a trend line, it's only a statistical way to find participation in the future, but it's just statistical. Why something grounded is something proven. And one thing that has been proven mathematically, for example, in 2009, that there is the existence of trends, and there is a paper I can give to you. And that is important, because then now it's actually bringing in the trend, the pictures of the trend and retracement, and it's something that is grounded. You can actually look at it. And grounded is also the effect of algorithms on price. The effect of these huge high volume algorithms can be objectively observed on price. Okay, and ask Jody Napoli, ask David Asley, ask these people, and you will see that that's the case. So are these events considered relevant to what price should do next? And what I mean here is that, do we really understand what happens to price? So when we look at price and the self-fulfilling prophecies, all the ideas that we put in with TA, are they really relevant? Well, if algorithms do not agree with your idea, your idea might well be doomed. So, I'm going to provide now examples on real market, and I'm a bit late here, so I will just continue, and actually I don't have a lot of time, but in the next let's say 5 minutes I want to do this. So this is not just theory, it's trading, algos trading is real. And let me start, let me show you this on the platform here. So let me close this. Just give me 1 second. This is the SP500 mini, but let's look at the euro here, and let me show you. There are very simple ways of using Fibonacci retraces that actually give us an indication of participation, where algorithms might participate. And this is a weekly time frame for the euro dollar, and I traced here a trace from the lows all-time lows in 2000s to highs in 2008. And look at how market comes and gets into this level twice. Now this is called the ambush trade. This is something that came into trading, into computer-based trading in the 80s when actually the CME pit traders, they started moving on the higher floors and using computers. So because they used to buy and sell at the 50% retracement. So this is one of the rules that has been internalized by program trading. And now if we have this level and area of support here, 121.25, there is 1 and 2 here. We can also see other regularities and see how program trading actually affects price. And if we start tracing from highs to lows here on this weekly time frame, we see that the market actually stayed within this area and never went above the 61.8%. So we'd start thinking that we can use that as our stop loss here. As you can see, the market gets into this first target, and these are the only levels I use in Fibonacci if actually you don't know my work. You can actually follow on my website, and I have there over 500 videos in which I review the market using these methods every weekend during the week as well. So in this market we can identify a sequence of measured moves. So the market actually hit the first target here and then retraces into the next measured move in this move over here. And then the market just continue lower into the second target. Now it's hitting algorithms that might participate on the long side here. And these are algorithms that are placed on the monthly time frame. So on the weekly time frame, we have algorithms playing short, and on the monthly time frame, we have algorithms that might participate long. And what happens is that when they actually participate long and actually break this sequence of measured move, and as you can see that happens here when price goes above this 129.40, what happens is that the weekly traders are not interested anymore in trading this market on the downside. And what happens is that they start trading this market on the upside. And what happens is that then again, we keep tracing until we trace to this level, and we know with 2 months in advance that we have this potential area of support. Now, would you trade this level alone? No, you would not. And you can use a technique like the fib stalking technique, which allows you to study the sequence of measured moves, so the presence of program trading on the smaller time frame, on the daily time frame, and when that sequence fails, then that's a potential confirmation. Then the MRC, the level number is 128.75. So that's a potential area of starting a potential area of support with a stop loss below 126.77. So and the market then started moving higher, and again in this case it didn't make it into the 141.04, and that's what I told you before. These algorithms are monsters, and they play a lot of volume in the market, but they have to respect fundamentals as well. And what are the fundamentals of the euro area at the moment, with a situation where the central bank should actually push money into the system, but it's not doing that because there's no agreement between the countries. And Italy, the place where I come from, unfortunately is on the verge of a default, and so program trading cannot push those prices higher if there are strong fundamental reasons for price to go lower. But those who follow me know that I trade this market using these rules that model program trading, And I made some studies on these rules. I worked with mentors, the mentors that I mentioned before, and in the recently, those who follow me know that I've been actually um, timing this trade here, and there were a lot of people who made money out of this trade. The point here is there is a structure in the market that it's brought about by algorithmic trading, and that's a huge reality, a reality that you cannot trade without taking that into consideration. And there are rules to identify what I call the footprints of algorithms on price. Excuse me. On all the time frames, and the price is the result of the combination of all these trends or sequences on the different time frames. So recently, in August the 1st, I offered an analysis for another pair. That's the US dollar versus Japanese yen, and those who follow me know that actually I had already identified highs to highs here in 94, and look at how long it takes. So I identified this level with 3-4 weeks in advance before it was tested, and then again, you don't have to buy these levels with stops. You have to. There are ways and techniques, the Phipps Tolkien timing technique, to time and enter in this market, get involved in this trade only when the participants, the algorithms and professional traders participating at this level actually move the price enough to break the sequence of measured move lowers in the other direction. Okay, so. Look at how long it took to get into 108.40. But when we were here, and we were actually on top of another level of area of support, and I mentioned this area of support at the beginning of August 2014. Eventually, after a few weeks, price got into that and always respected the 61.8%. So you can go back to my website and look at this reviews. And you will see that. Go also on fstrade.com, look for Japanese economy, and look at the analysis I did at the end, at the beginning of August. I think it was published. I did it before, but it was published at the beginning of August. And I mentioned 108, 107, 30, 108.50, and we have a target above 115. And the reason why we have those targets is that the algorithms will do whatever it takes to bring their price into target. The only time when they have to stop or they have to reconsider the market is during planned news, and they do not participate on the smaller time frame during those events. Those are events where emotions play a lot, and some people they only trade using that. So Adinda is telling me that we have to wrap up here. So I just wanted to tell you, go on my website and look at my research. I work with some mentors, so it's not all my stuff, but I actually adapted the method to work also on the higher time frame, because not everybody has time to trade on the smaller time. And I myself, I don't want to be in front of the computer for 12 hours. And I'm also starting a coaching program on these concepts. Actually, it's going to be very, very practical. But before you get involved, look at my work on the website. If you have any question, you can send me an email and go to my website, phipstalker.com, and you can also subscribe to the free newsletter. I give these reviews twice a week, and you can see how I use this concept. And if you are interested, I'm starting a coaching program on October the 4th. Just send me an email if you want to learn more about that. So this is everything I wanted to tell you today. I want to thank you very much for taking the time to be here. Thanks a lot to FSTrade for giving me the opportunity to present this to you. I hope I put you a seed of doubt in your mind. And if you have any other questions, please come back to me. and I'll be very happy to discuss further with you. Thank you very much, and I'll see you soon. And if you are interested, I speak about this concept also on a lot of webinars on FS So go to my page, Giuseppe Basile, and look at those. Thank you very much, and thank you, Paul Pantelis. Thank you, Adinda, and I'll see you soon. Bye-bye now.